Hello there. Today I'm going to show you how to do a basic international project appraisal, FDI, foreign direct investment. We're going to look at this article that came out recently, September 2013, ACCAP for student accountant. Now you could download this article at this site. Okay, now this question, there is a sample question in this article which will be similar, very similar to what you will see in your section B of your 25 marks question based on the present syllabus. Now looking at the bottom of the question, there's a requirement. Now that requirement tells us that prepare a financial assessment. Now financial assessment usually in P4 is usually it's going to be net present value. Yep, net present value of the project covering the initial 2 year. Now initial 2 year, that means we have to remember that could be some discussion or that could be some valuation of real option, but in this question it's going to be pure discussion. So it's going to be some real option embedded to this project, yeah, options attached to this project, assuming parent company appraises projects by discounting. So this is reinforcing the NPV here. They are reinforcing by telling you the word discounting, so it's going to be pure NPV. Now discounting nominal. Now the word nominal is simply that make sure all your cash flows include an element of inflation. Every cash flows, whether it's a foreign cash flows or whether it's going to be a domestic cash flow specifically related as a result of this project, should include an element of inflation. And then they go on to say that it has to be discounting the dollar cash flows. Now that means you must find out what is going to be this dollar. Is it going to be the home currency or is it going to be the foreign currency? So we're going to make sure that we have to discount this dollar cash flows at an appropriate cost of capital. Now again, they say the word appropriate cost of capital. Now what do you mean by appropriate cost of capital that you should know by today? There are three cost of capital that you will use in an appraisal process. The first one is simply going to be your existing business WACC. Sorry, existing WACC, hey WACC, yeah? It's going to be your weighted average cost of capital. This is usually for when the business risk is the same and when you're still going to finance the same project. Now the second one is going to be your risk adjusted WACC. Risk adjusted WACC. Now risk adjusted WACC, you must remember the project is going to be financed in the same way as all other existing projects. Then you use risk adjusted WACC, but the business risk is going to change. Now you must remember that this is a foreign investment. There would be definitely some changes in the business risk. It could go up. It could go up, leading to an increase in your WACC, or it could go down, leading to a decrease in your WACC. Now, when will it go up? When you are going into riskier countries, yeah. When you're going to a very high political risk countries, the countries that has got low economic policy. All these things is going to affect your risk adjusted WACC, and you're going to do probably some adjustment upwards. And sometimes it's going to be treated as a diversification. So if you're going to diversify, the examiner might say that your risk adjusted WACC may go down by a certain percent, or probably they would give you, yeah, probably they'll give you a similar company or similar proxy company operating in that country where you have to do some adjustment of risk betas. Yeah, you're going to adjust the betas, you're going to ungear and de-gear them. Yeah, but later we will see in this question there's no such case, because we are told the exact cost of capital that we're going to use. So no worries about that. Probably in other questions we'll look into that one. Now the third way is going to be simply the adjusted present value. Now you use this approach, you must remember that you use APV. Whatever happens doesn't matter, but what if your finance is going to change? Now if your finance is going to change straight away, you're going to consider your APV. Whether your business is changing or not, it doesn't matter. So when your finance is changing, we're going to consider APV. Now that'll be good if you have time to go and see the question on December 11. Yeah, you're just going to try and see December 11. There's a question on this foreign investment dealing with APV. Now state clearly, coming back to this question, state clearly any assumptions that you may want to make. Now, explain the main risk and issues faced by pen company if it chooses to undertake this project. What is the main risk? What are the risks you have here? And what are the issues? So one is going to be risk, and two is going to be issues. Now, issues you can talk about is going to be your qualitative factors. What are your qualitative factors? Think about qualitative factors as we read this question later on. What are the qualitative factors that you want to write if it chooses to undertake this project? And the written bits is more than half, yeah, 14 marks, and the computational bit, a financial assessment, together with some assumptions that we're going to write down a bit here, written a bit, is only carrying 11 marks. So this is the requirement. Now going back to the first paragraph, let's go up. Now let's put the paragraph number. Okay, now let's do the paragraph number for easy reference in the future. Now this is going to be I'm going to call this paragraph number 1. Now Pen is a successful company. Okay, they're a very good company based in the European countries. So this is where they are situated. It's in one of the European countries. We're not told the country's name, so we're just going to say the country is Europe, and the local currency is dollar. Probably it's euro dollar, but we're just going to say it's dollar. And inflation has always been stable at 5%. So the economy does sound is stable at 5%. Income tax is charged at 25% and is payable in the same year in which the profits is earned. Okay, now what can we see here is the inflation. Now whenever they tell us inflation, there's two reasons why you're given inflation figure in this country. One is to make sure your cash flows are reflected with inflation. So we're going to make sure that is going to be at nominal cash flows. We are told that just now in the requirement that your cash flows must be nominal. So that's why they give us inflation rate to adjust any cash flows which are real cash flows into nominal or money cash flows. Another reason why they're giving you inflation in an FDI is going to be to forecast your future exchange rates. Now that will be probably using purchasing power parity theory, and usually purchasing power parity theory is used to forecast long-term exchange rates. Now income tax, here they're giving us 25%. 25% is for you to see if there's any tax payable locally when you come back home. Usually you pay tax in the foreign country, then you come back home, you're subject to local tax. For example, if you pay tax in the foreign country 20%, you come back home, if you do not have an agreement with that country, you pay another 25%. Usually there will be an agreement. If it's not mentioned, you just assume whether there is or there is not. If there is an agreement, you come home, double tax relief, yeah, DTR. If there is an agreement, you come back home, you only pay 5%. Yeah, take note of that. Now, so we are told here. Now going back to the requirement here. Going back to the requirement. if you look at it here, yeah, if you look at it here, if you look at this point, I'm pointing at this point here. Now, if you look at it, this one here, this is telling us it's going to be in a dollar million. That means we're going to discount using this dollar, discounting using this dollar cash flows. Now, and happens that this is dollar. That means you're going to discount domestic cash flows. Is that okay? We're going to find out a domestic cost of capital. We must be given a domestic cost of capital because we're going to discount domestic cash flows. So domestic cash flows, yeah, domestic cash flows. Can I just put domestic cash flows? Make sure you discount using domestic cost of capital. Yeah, domestic cost of capital. Now, second thing that we're going to see here in the second paragraph. The company is listed on several major stock exchange and it has operations all over the globe. Its market capitalization. Now, market capitalization, you should know by now, is going to be the total market value of the company. You take the number of shares, you multiply with the share price, you're going to get your value of your equity in total. And they have a bond value which is at 145. So you're going to have sorry, this is going to be value of a debt, yeah, value of a debt. So you got this. Probably they're giving us this just to make sure we know what to be this finding out the cost of capital probably. Okay. Paragraph number 3. The Treasury Department of the company regularly computes the company's nominal cost of capital that has been fairly stable at 10%. Now this is going to be your WACC, existing WACC. However, when Penn Company have carried out projects in developing markets, in an emerging market, yeah, if it's going to be in an emerging market, it has been used a nominal risk adjusted at 12%. So you're gonna do a business in an emerging market, so there could be some risk adjusted to it, and they're not giving us any proxy company beta for us to ungear and regear. So just giving us an adjusted risk adjusted WACC of 12%. So this is going to be my cost of capital, and this is going to be your domestic cost of capital. Okay, so fourth paragraph here. Penn Company primary business is the construction and laying. Now this is what I have here. This is a very important word. Their main job business, their existing main business is construction and laying of train tracks and tram lines. Their main consumers are governments due to position of the market leaders. Yeah, Penn is a market leader and most governments give them job. Penn has a record of completing, that means they are a very good reputable company and they do it in an ethical manner. Now the next paragraph, number 5, is CEO of Penn has currently attended the trade delegation to Africa, where he met the Prime Minister, the PM, and a fast developing country called Zanadia. The Prime Minister and his political team provided Penn's CEO with an outline of the contract that Zanadian government would like to award to Penn. Okay, so this is what you have here. First 5 paragraph relating to Penn, and also what Penn has done in the last delegation to trip to Africa.